All right, before we dive in, just a quick but really important heads up. This is all for informational purposes. When it comes to your money, please always chat with a qualified financial advisor.
Hey everyone, and welcome. Today we're talking about something huge that's about to hit the Indian investment world. SEBI has just dropped a whole new set of mutual fund rules for 2026, and believe me, they're going to change the game for all of us.
So let's get right to it. The big question on everyone's mind is probably this. What's going to happen to my SIPs and my portfolio come April 1st, 2026? These changes could seriously save you some money, but they might also mean you need to take a fresh look at the funds you're holding. So let's get into it.
Now, just to give you a sense of how massive this is, SEBI is replacing regulations that have been around since 1996. Yeah, you heard that right, nearly 30 years. So this isn't just some small tweak, it's a complete ground-up overhaul, and it's built for the way we invest today.
So you might be asking, why the huge change? What's the end game here? Well, it really boils down to three main goals SEBI has for you, the investor, giving you way more transparency, bringing down those pesky costs, and making sure a fund's name actually tells you what it's doing with your money.
All right, so at the heart of all this are 8 major changes. We're going to walk through every single one so you know exactly what to expect.
First up, and this one is arguably the biggest deal of them all. We're saying goodbye to the old total expense ratio, or TER, and hello to a new system called the base expense ratio, or BER. The key difference? The BER unbundles the fees, so the main fund management fee is now totally separate from other costs like brokerage and taxes. This slide really says it all. You know, the old TAR system just lumped everything into one single number, kind of hiding what you were really paying for. The new BER system pulls back that curtain. It separates the management fee so you can see things with a clarity we just never had before. The second big change. This is just fantastic news for investors. SEBI is actually lowering the maximum amount that funds can charge in fees. And it's simple, right? Lower fees mean more of your money stays invested and works for you, instead of going into someone else's pocket.
And check this out. For really popular funds like index funds and ETFs, the cap is dropping. Now, I know it might not look like a huge change on paper, but trust me, over decades of investing, paying even slightly lower fees can make a massive, massive difference in your final returns.
And it's not just index funds. For other equity schemes, the new BR limits are being cut by up to 15 basis points. Now, a basis point is just a fancy way of saying 1/100%, so this is a really significant cost saving across a whole bunch of different funds. Okay, moving on to change number 3. CBI is getting much tougher on brokerage fees. As you can see, for the cash market, the cap has been literally cut in half, from 12 basis points down to 6. And for derivatives, they've introduced a new cap where there wasn't even a specific one before. This directly slashes the fund's internal trading costs.
Next up, we've got a couple of key changes for equity funds. It's kind of a two-sided coin here. On one side, funds are getting more flexibility. They can now invest up to 35% in things outside their main strategy, like gold or debt. But on the flip side, some categories like value, contra, and focused funds are getting stricter. They now have to keep at least 80% in equity, up from 65%, to make sure they're truly living up to their name.
Have you ever looked at 2 different funds from the same company and thought, wait a minute, aren't these kind of the same thing? Well, SEBI's putting a stop to that. The new rule says that similar funds from the same AMC can't have more than a 50% overlap. This is great because it means they have to be genuinely different.
And finally, there's a huge shift happening in goal-based funds. Those old standalone retirement and children's funds, well, they're being phased out. But what's replacing them is actually pretty smart. They're introducing something called life cycle funds. Think of these as funds that automatically adjust for you, shifting from stocks to bonds as you get older and closer to your goal. It's a much more hands-off, dynamic approach. So, we've run through the 8 big changes. But now we get to the most important part. What does all of this actually mean for you, for your money, and for your strategy?
Okay, so the impact really comes in 2 flavors. The good news is undeniable. Lower costs and clearer fees should mean higher returns for you in the long run. Plain and simple. But there is something to keep an eye on. Because of these new rules, some of the funds you currently own might have to change their category or tweak their whole investment strategy.
Knowing all this is one thing, but what should you actually do? To make it easy, here's a simple action plan to help you get ahead of these changes. Here are 4 simple steps. First, go look at your fund fact sheets now so you know what their strategy is before anything changes. Second, keep an eye out for emails or notices from your fund house. They have to tell you if they're making a change. Third, and this is the most critical step, ask yourself, after the change, does this fund still fit my financial goals? And finally, when you're making new investments, check out these new life cycle funds and see if they make sense for you.
So the bottom line is this. While these changes might mean you have a little homework to do, they are fundamentally designed to protect you, the investor, and to make the whole world of mutual funds in India a lot simpler and more transparent.
And with that, I'll leave you with something to think about for your own portfolio. Of everything we've talked about today, which one of these 8 changes do you think is going to have the biggest impact on your SIPs and investments?
Thanks so much for joining us. Remember to stay informed, stay invested, and always do what's right for you. We'll see you next time.